Fed Chair Kevin Warsh has initiated a massive regime shift in central bank communication. At the June 17th FOMC press conference, Warsh chose not to submit his own interest rate projection. In the press conference, he described the dot plot as a draft sketched in pencil that can be erased at any time, signaling a complete rejection of traditional forward guidance. By refusing to feed policy expectations to the market, the Fed is forcing trading institutions to interpret economic data on their own. This communication pivot is immediately visible in the Fed's documentation. The June policy statement is over 60% shorter than the previous release, shrinking from 345 words to just 132. The Fed has stripped away qualitative forward guidance, including phrasing about whether future rate hikes or cuts are likely. Additionally, the statement no longer details individual official voting records, preventing markets from parsing internal divisions to trade future policy moves. To cement this new operational style, the Fed has established 5 internal working groups. These groups are tasked with reforming central bank communication, balance sheet policies, and economic statistics, with recommendations due by the end of 2026. This indicates that the Fed is preparing a deep structural overhaul of how it monitors the economy and interacts with financial markets. Even though Warsh refused to submit his own forecast, the remaining 18 FOMC members did. The resulting dot plot reveals a deeply divided central bank with a hawkish tilt. 9 members expect at least a 25 basis point rate hike by the end of 2026, while 8 expect rates to remain unchanged, and only 1 expects a cut. This shows that the consensus for the terminal rate trajectory is shifting higher, despite rates being held steady today. This hawkish tilt has received unexpected support from Donald Trump. In recent comments, Trump stated that further interest rate hikes are possible and that keeping interest rates unchanged is no problem. This rhetoric removes significant political pressure from the central bank, giving Chair Warsh the flexibility to maintain a higher-for-longer policy stance if inflation persists. While the public rates market adjusts, the private credit engine is showing signs of a slowdown. U.S.-focused direct lending issuance fell roughly 40% in the 3 months ending May 2026 compared to the first quarter. This decline indicates that the private credit boom is reversing as new capital inflows slow down, challenging direct lenders who rely on continuous capital recycling. In response to market complexity and data noise, retail traders are changing how they use artificial intelligence. Instead of using models simply to write code, traders are building inference architectures. This involves wiring large language model reasoning directly into trading systems to automate complex information synthesis and pattern recognition, helping traders identify emerging market themes across dozens of daily reports. To maintain the performance of these AI assistants, developers are prioritizing context hygiene. Large language models tend to lose reasoning quality as chat threads grow longer. By isolating different architectural layers, such as data parsing, theme brainstorming, and risk analysis, in separate chat threads, developers prevent reasoning degradation and context contamination. Within mega-cap equities, Meta is trading at a significant valuation discount relative to its peers. The company currently trades at an 18 forward price-to-earnings ratio, compared to 21.5 for the S&P 500 and 27 for the NASDAQ 100. This discount suggests that the market is pricing Meta with a high degree of skepticism, despite its strong underlying financials. Much of this skepticism is driven by headlines highlighting a 20 million user decline in the last quarter. However, this user drop was primarily caused by regional restrictions in Russia and Iran, rather than a drop in organic engagement. In fact, organic usage across Facebook and Instagram continues to grow, and Threads has reached 500 million monthly active users, providing Meta with a new monetization pillar. In the hardware sector, Credo Technology Group is benefiting from AI data center demand, but faces extreme customer concentration. In recent filings, 2 customers accounted for 85% of Credo's total revenue, with customer A representing 50% of sales. This concentration introduces significant supplier risk for investors if either hyperscaler reduces capital expenditures. This data center build-out is hitting physical bottlenecks as transfer speeds increase. At PCIe 6 speeds, signal attenuation and copper wiring creates hard distance limits of just 4 inches. To solve this, companies are using active components, like Astera Labs' Aries 6 Smart DSP retimer chips, which extend the reliable reach of copper links to 12 inches, avoiding the need for expensive optical connections. Observability is emerging as the critical gating factor for enterprise AI agent deployment. Companies cannot scale non-deterministic AI agents without clear traceability of what the agent did, what data it used, and why it took an action. This observation bottleneck benefits observability platforms like Datadog, which has maintained a trailing 12-month net revenue retention rate of 120%.